Good morning, business. Good morning, ma'am. So, we are the group 3, Abad Roderick, Columna Gisalim, Kotanda Jilin. So, we're going to report the Chapter 23, Capital Asset Pricing Model and Modern Portfolio Theory. Capital Asset Pricing Model, or CEPM, is one of the major developments in modern financial theory, widely used in investment analysis. So, dako na kainig invest or kuan ang kaning capital asset because you invest money. Asset pricing model is a model based on the proposition that any stock's required rate of return is equal to risk-free rate of return plus a risk premium that reflects on the risk remaining after diversification. Total risk may be separated into two major components. First is diversifiable risk or unsystematic risk or company risk. Is that part of a securities risk caused by factors unique to a particular firm. So, just like kuan ba sa work nga, sa work ra jud siya. And second is undiversifiable risk or systematic risk or market risk. Is that part of a securities risk caused by factors affecting the market as a whole. So nakaapekto jud ni siya sa market whole kay naman siya sa market like naay mga kakulangan sa mga product kanana. Illustration of figure 23 to 1 effect of diversification on unsystematic and systematic risk. There are several answers to the question. First is high administrative costs and commission would more than offset the income for individual investors. Second is index fund can be used by investors for diversification and many individuals can do get broad diversification through these funds. Third is some people believe that they can pick stocks that they will beat the market. Fourth is some people can through the supermarket your analysis beat the market so they find and buy undervalued stocks. Capital asset pricing model. If we know the risk as measured by beta for a particular share, we can use the capital asset pricing model to determine the security's required rate of return. The capital asset pricing model, known as CEPM, is a model developed to help to determine a share's required rate of return for a given level of risk. Required rate of return is equal to risk-free rate. Additional compensation required for investment in a risky asset is equals to price per unit of risk or beta. Price per unit of risk is equals to return the market minus risk-free rate. Required rate of return is equals to risk-free rate plus return in the market minus risk-free rate. Thank you.
My topic is all about the beta coefficient concept. When a stock is held by itself, at risk can be the standard deviation of its expected returns. However, the standard deviation is difficult to use when the stock is held in a portfolio, as stock general or systematic risk is measured by stock beta coefficient. Beta is a measure of the sensitivity of a security's return relative to the returns of a broad-based market portfolio securities. Beta is also defined mathematically as the ratio of the covariance of returns of security and markets portfolio to the variance of return of security. Average risk stock is defined as the tends to move up and down and step with the general market as measured by some index, such as Dow Jones Industrial and the S&P 500 or the New York Stock Exchange Index. And figure 23.2, relative volatility of stock A, B, and C. Graphs are the relative volatility of three stocks. The data below the graph has shown that in 2012, the market, defined as a portfolio consisting of all stocks, had a total return dividend yield plus capital gains yield. Of return on the market, 10%, and stacks A, B, and C for high, average, and low risk. Also had return of 10% in 2013, the market went up sharply. And the return in the market portfolio was 20%. Return on 3 stack also went up. A soared to 30%, B went up to 20%, and the same as the market, and C only went to the 15%. Now, suppose that the market dropped in 2014 and the market return was 10%, negative 10%, the three stocks return also fell, applying to negative 30%, B falling to negative 10%, and C is going down only to 0%. Thus, the three stocks all move in the same direction as the market, but A was by far the most volatile, and B was the volatile as the market, and C was less volatile. Beta measures a stock volatility relative to an average stock which has B equals 1.0, and stock beta can be calculated by plotting in a line like those in figure 23-2. The slopes of the line show how each stock moved in response to a movement in the general market, and the slope coefficient of such a regression line is defined as beta coefficient.
Portfolio beta coefficient. A portfolio consisting of low beta securities will itself have a low beta because the beta of any set of securities is a weighted average of the individual securities. So the formula of beta coefficient is a formula beta equals the sum of products of individual investment weights and beta coefficient of those investments. It is a measure of the systematic risk of the portfolio. So beta could be calculated by the first dividing the securities standard by the standard deviation of returns. The resulting value is multiplied by the correlation of the securities returns of the benchmark's returns. So, a beta coefficient, on the other hand, is a measure of systematic risk which cannot be diversified. Adding more assets to a portfolio does not reduce the portfolio beta. Illustrative case 23-3. Calculation of portfolio beta. You can determine the beta of your portfolio by multiplying the percentage of the portfolio of each individual stock by the stock's beta and then adding the sum of the stock's betas. Relationship between risk and rate of return. Financial managers and also managers, for that matter, must have a firm grasp upon the trade-off between risk and return. The capital asset pricing model expresses risk-return relationships using beta as a relevant risk measure. So this is the formula of our capital asset pricing model. The RI is capital asset expected return. RF risk-free rate of return. RM expected return on the market portfolio. BI beta coefficient of security. So the risk-free rate of return is the return required on a security having no systematic risk and is generally measured by the yield on short-term treasury securities such as treasury bills. So these are two components of risk-free rate. First is a real rate that excludes any inflationary expectations. Second, inflation premium that equals the expected inflationary rate. So the rest premium is the return required in excess of the risk-free rate and is due to systematic risk. Market risk premium is the part of risk premium which is the additional return expected for holding a market portfolio of average riskiness. Illustrative case 23 to 4. Determination of portfolio required rate for return using CAPM approach. To calculate the required rate of return, you must look at factors such as the return of the market as a whole, the rate you could get if you took on no risk. So, risk-free rate of return and the volatility of a stock. To calculate required rate of return using the capital asset pricing model, subtract the risk-free rate of return from the market rate of return. Multiply the above figure by the beta of the security. Add this result to the risk-free rate to determine the required rate of return. Security market line. The capital asset pricing model is expressed graphically by the security market line. The security market line represents the linear relationship between a security's required rate of return and its risk as measured by beta. Illustrative case 23 by 5. Investments decision based on SML. The security market line is an investment evaluation tool derived from the CAPM, a model that describes risk-return relationship for securities, and is based on the assumption that investors need to be compensated for both the time value of money and the corresponding level of risk associated with any investment, referred to as the risk premium. That's all, and thank